back, everyone, to our monthly investor webinar. If you're here with us last month, welcome home again. If this is your first time, I think you picked a great one to start. We're going to be talking about investing versus saving. This is going to be short and sweet, so 30 to 45 minutes, but I promise you it's packed with a ton of valuable information. So uh, feel free to ask questions at the end. Toss it in the chat. I'll be able to take a look at it afterwards, and then I will definitely be answering it. So today's topic is one that I'm really passionate about because this is a conversation that I wish someone had with me 10 years ago, or I don't know, 15 years ago. And it's not how to earn more, and it's not even how to budget better, right? But actually where your money should go once you have it. Because, like our goal is to make money and to build wealth, but where should it go? And this is what I've noticed working with hundreds of high income professionals, right? Most of you, the truth is, you're not bad with money. You're responsible. We save, like we are good savers. You're not reckless at all. But the gap isn't discipline. The gap is like deployment. What are you doing with that capital? And you're not even sure where it's supposed to stay, and when it's supposed to move. And so I think that's the bigger conversation that we should be having. And that uncertainty, it's what keeps a lot of smart people kind of on the sidelines because they don't know what to do. And it has cost years, like a lot of us, right? It's cost years that we haven't built wealth as much as we are capable of doing it. So that's what I want to talk about today. And I'm kind of excited to jump right into it. And I want to start first by defining terms because I think this is where a lot of people get confused, maybe a little bit. Saving and investing, they're not the same thing. They serve, I would say, like they serve completely different purposes. So it's very important for us to understand that. And if you treat them kind of like interchangeably, I think it's one of the more expensive mistakes that we make. So I would think about saving as more like protection, right? So the priority is access and safety. That's what you should think about when you think about saving. You need to know that that money is there when life throws something at you, and sometimes life doesn't mess around. But that money needs to be liquid. It's honestly, it's boring. It's supposed to be boring. That's its job. It's supposed to protect, be safe, be easy to access, very liquid. And then investment is more about deployment. So savings is, think, safety, protection. Investment is deployment. And the priority here is growth and income. That's what it should do. Like it should grow and it should produce income because, and this is why I think about it like that. This is how I think about it. You're putting your money to work to build wealth, whether it's generating passive income or it's actually doing both, right? But that money is less liquid and it carries a little bit more risk. But in return for that risk, right, it should produce kind of returns that your savings will never give you. That's the big thing. And that's why you want to deploy. So not only protect with savings, but you also want to deploy. Both are very necessary and neither one of them replaces each other, right? You need savings, but you also need investments. And I think that the mistake that a lot of people make is that they're treating all the money like it belongs in one category. Like you just have this one big pot of money. And some of you, right, are over saving. You have too much cash that's just sitting idle because it feels safe. It's good to see a pile of money, be like, oh, I got this, right? And then some of us are over investing, so deploying money that you actually need for stability. So I think there's a fine line between both of them. And today I want to kind of help you figure out the right balance for your situation. And this is something that kind of I've learned along the way. And I'll kind of share with you what I used to do and what I do right now. So this is the framework that I want you to take home today, right? And I call it kind of like the three buckets. Every dollar that you make or that you have or that you own should live in one of these three places. And once you understand the purpose of each of the bucket, right, you never again wonder like where money should go. And so the first one, sorry, a second. The first bucket is the safety net. I think about this as like 6 months of real living expenses. So I don't want this to just be your salary, but like what your life actually costs per month, multiply that by 6. And this is kind of where you do a graph of everything or like a chart or an Excel document of like really all your expenses and then be able to see that. And you can actually you don't have to put in exact amounts, but you can use AI to help you build this out. But build out like what life actually costs you per month, and then multiply that by 6, and that's your safety. This money can sit in like a high yield savings account or money market that is like easily accessible and that you're not penalized for it. So it's going to earn a little bit of interest, but that's not the point. The point is access and protection for this money. So when life happens, and I told you it will, right? The money, you have access to that money within 24 hours. No penalties, no selling anything, no stress. That you should think about that, right? This money in that bucket never gets invested. And I can't emphasize this or overemphasize it, right? This money should not get invested. This is your safety net. It's not like, it's not idle capital that's sitting, that's not doing anything, that's waiting for an opportunity. It is not that. It is the foundation that makes like everything else really possible. Because I would say this, right? When you have a safety net, you invest. When you have the safety net, right? You invest from a place of kind of strength, from a position of strength. That's how I think about it. And when you don't, right, every investment like carries the extra weight of also being your emergency plan. So like when you don't have a safety net and you're like, okay, I still want to invest, right? You don't invest freely, right? You're worried about every single penny. You're thinking about this money every night before you go to bed and when you wake up in the morning. And that's not what, like that, you're going to make a terrible investor every single time because you don't have that safety net. So that's bucket one. Bucket two is, I think about it like the growth engine. So this is like long-term wealth building, right? So this is your 401k, this is your 403b, this is your IRA, your index fund. This is like, if you do backdoor Roth, this is your backdoor Roth, right? This is kind of like your growth engine. Think long-term. These are, I think about this as like compound growth vehicles. So you put the money in, and you don't touch it, and you let time do its work, right? And most of you listening are already doing this, and you should. I would say, at least if you don't do this, you need to max out your employer's match, like at the minimum. And I would then say, like, use these tax advantage accounts, right? They're going to be the foundational to start building. But this is what nobody tells you, right? This second bucket alone, it won't give you financial freedom before you're like 65 or 63, right? It's designed for like that traditional retirement, but it's there. If your goal is options right now, if you want freedom in your 30s, 40s, 50s, whatever that looks like, right? If you want the ability to like even reduce your work hours, or for some people, some of us, walk away from your job that you've like worked enough that you're like, I've done this, I want to do something else, right? Bucket two alone is not going to get you there, but it's part of the plan, but it's not the whole plan. That's how I want you to think about bucket two. So it's important, but it's not the whole plan. And then bucket three is like the income builder. This is where I think kind of the game changes, and I want to spend some time on this, and I will spend some time on this. But these are like cash flowing assets that they pay you right now. They don't pay you in 30 years. They pay you now. They pay you quarterly, maybe monthly, but they're consistent, right? Think like real estate syndication, rental properties, private lending, even think about like business equity, right? Oh, also digital assets. So like a course, but anything that's like generating revenue right now, anything that is producing income, whether or not you show up for work today, right? That's how you should think about this third bucket. And this is the bucket that a lot of high earners are missing, right? They have bucket one because we're savers. And then they have bucket two because kind of they're required to do it to some degree, right? And then they wonder like why they still feel financially dependent on their career. It's because you skipped this third bucket. And this bucket is the one that actually buys freedom. So I want to spend a little bit of time talking about this one. And I told you the bucket three is where kind of the game changes, right? And I don't want to leave you with just a concept, like what does it mean? I want to give you kind of like an actual menu, because when I say like cash flowing assets, most people nod. They're like, okay, yeah, sure, that makes sense. But what is it really? And what does it mean in practice? So I want to break that down. And I'll start with, what we've talked about here before, which is real estate syndications. And this is simple. If you haven't heard about it before, it's just where you invest, as a limited partner in a larger property. Think about like maybe an apartment complex. And then you have the general partnership team. They find the deal, they manage the deal, they handle kind of day-to-day operations, and your goal on your job is to invest the capital, and then you're going to be getting quarterly distributions that come from rental income. This is kind of a little bit more illiquid, like we know. The money's held for about 3 to 5 years, and so you own the property, but you just don't take care of the day to day, so you don't have the headaches of really being a landlord. And this is what we do at Phoenix, and that's how I started really as a passive investor. So that's an option. And then a lot of people kind of skirt around like private lending, but people don't know what it is. So in this kind of, when you think about this as a cash flowing asset, right? In this kind of model of private lending, you're essentially becoming the bank, right? You're going to lend money to the borrower. But that is typically most times secured by real estate, but then you earn interest on that loan. So that's what is cool about it, right? And the returns can be very attractive, but there's always a but. The due diligence is different, right? You need to understand the collateral, you need to understand the borrower, and you need to understand what happens if they default. So this is one that I would say it's good, right? Because again, the returns are really attractive, but I would go in kind of, first of all, truly being educated, truly understanding the process, truly understanding the borrower, and then build, right? So maybe start a little bit smaller and then build. That's how I would think about this. But if you have the capital, this is a really great way to earn some additional income. And then I talked about business equity, and kind of that this works how in a way that you invest in or you acquire part of a business, and it's a business that someone else operates. So it could be a franchise, it could be like an e-commerce company, it could be some sort of service business. But if the business is structured well, right, then the revenue is going to flow to you as an owner without you doing kind of the day-to-day operations. And this, I will say this can be incredibly powerful, but it all depends on the quality of the operator. So who's operating it, who's running it, right? That would depend on kind of how much money you get, because the better they run the business, the more it flows to you. And then also in this category, I would also even put like dividend producing stocks and like funds. And so think about these more. Of course, they are public equities or funds, but they're specifically for like consistent income. So they're not just growth. So you're not buying like Tesla hoping that it's going to go up by 40%. You're buying established companies or funds that pay you quarterly dividends. So this is another way of thinking about like a cash flowing asset. And this is not as exciting, right? But it's consistent cash flow. And if that's something that you want, then think about that. And then I mentioned digital assets and royalties because like I think a lot of us don't think about it, but it can be really it can be a really cool way to produce a cash flowing income of some sort. So think like online businesses, courses, licensing deals, anything that's like intellectual property that will generate recurring revenue. You should think about that. So if you have built an expertise in your field, right, you can find a way to monetize that knowledge. Again, it's without trading time for money, because that's the whole beauty about this third bucket. Now, all of these are not equal, right? They all carry different levels of risk, like I told you with the private lending, and they all have different like return profiles, right? And a lot of them have like different time commitments and also taxes. You have to think about tax implications. So I'm not telling you to do all of them. I think the best strategy is like pick one, go deep, learn it really well, and then deploy with confidence. Like I would say like one that you understand really well in this asset, in this like bucket 3 asset, it'll do more for your financial freedom than if you like look at all of them and be like, oh, tomorrow I want to do 1, 2, 3, 4, 5, right? So I would say at the end of the day, I always talk about this, which is actually why we're here today, which is education and learning, right? I think learn whatever you're doing really well, be able to explain it to others, right? And know that well. And then whenever you make a decision, you're making it with a lot more confidence. And so that's bucket 3. So, and now I want, you can say this out loud, or you can put it in the chat, or you can just think it to yourself. But do you currently have money sitting in a savings or checking account beyond your 6-month emergency fund, right? If like again, if that's you, just pay attention to that and ask yourself kind of why. And so, kind of ask yourself like how much goes where. And I want to start with kind of a framework. And this is not a rigid rule, right? The numbers, again, will always depend on your lifestyle, your income, your expenses, your goal, your family, your risk tolerance. There's a bunch of stuff. So my plan is definitely going to be different from Mary's plan, right? But I want you to think about it, everything as like there's a starting point that works, and then build from that. So I alluded to bucket one, which is like the savings, protection, safety, all of them. Fund that first, right? Again, I told you 6 months of expenses. This is non-negotiable, right? Until this is done well, I think everything else has to wait, right? Because if you like, you want to be safe, and that's the word. Before you go on and do all these other things, I think the prudent and the smart thing to do is safe. And so if you don't have that, right, your priority before you leave here today is to figure out how to start doing that. Open a high yield savings account, set up automatic transfers, build that first. That's very important. And then bucket two, at minimum, I told you, like, you should be maxing out your employer match. Like, it's free money. You're leaving it on the table. So just take it, right? And so that's kind of what you're, and then if you have more capital, right, I would say talk to your kind of your advisor, your tax strategist, but think about doing the backdoor Roth if you're eligible to do it, right? But again, this is having a conversation. The first conversation we had in our monthly webinar series are, what's the question of who do you have around you? So who are the experts that you have around you? This is a conversation that you can have with one of them, especially because they're going to know your specific situation. So now here's the question, I think that changes everything, right? After your safety net is fully funded, right, and your retirement contributions are set, what's the rest of the money doing? Where is it going? What are you doing with it? And a lot of high earners, right, the answer is this, like, it's sitting somewhere, maybe in a savings account, and it's earning like 0.0 something to maybe 3%, right? Or it's in a brokerage account that's earning market returns, which is good. But I think that kind of, you think you're being responsible and you think you're doing the right thing, and you are, right? But you're leaving a significant amount of potential on the table, because that any money above like bucket one and two, right, that's like bucket three capital to do something with it. And so, and if you're investing in the market, that's great, right? But also be thinking about additional things that you can do. So how can that income be building multiple income streams for you? How can they be generating additional cash flow? Because at the end of the day, right, the reason why we invest and we build is so that we can have options. And you don't want it to just be sitting right there. You always want to be thinking, like, how can this give me the options that I need, which I think is very, very important. And so I want to show you something that reframes like how you think about playing it safe, right? Because we have been taught, we're taught all the time that keeping money in savings account is the responsible, it's a conservative thing to do. It's just like, you want to be safe. And for bucket one, right, for that bucket one money, which we talked about, it's absolutely true. You want to be safe. You're not spending that money. You are playing it safe, right? But for money that's above your safety net, right, playing it safe has a cost, and it's just kind of invisible. You don't see it. So I want us to run the math a little bit, right? Let's say you had $2,000 that's sitting in a high yield savings account, right? Oh, a 200,000. I hope I said that right. Let's say you have 200,000 that's sitting in a high yield savings account, and let's just say it's really good at it. It's earning you 4.5%, but really I think it's more like 3 and something. But let's just say 4.5, right? And so that's about $9,000 a year. It's good. Yeah, it's good money, and it feels safe, right? Now imagine if that $200,000 is deployed across like cash flowing investments. Let's say that's earning you like double that. So let's just keep it safe, keep it simple. Let's say 8 to 10%, right? That doubles. So that looks like 16 to 20,000 a year in just like passive income. Plus, when you are in these different cash flowing assets, right, there's potential for appreciation, and there's also potential for tax benefits. So that's something that you're thinking about. That's money that you're not seeing, that is also potentially appreciating. So think about the difference, right? The difference is anywhere from like 7,000 to 100,000 a year, and that's like 7,000 to 11,000 a year. And that's every single year. So that's not, I want you to think about that's not a rounding error, right? That could be like, I don't know, maybe family vacation that you didn't take. For people who have kids, that could be like 3 months of your child's tuition, just depending on if you want to put them in private school, right? But that's the beginning of like passive income stream, and that's what that could look like, right? And eventually, as you build that, right, again, after bucket one and bucket two are taken care of, right, that could replace a day of work per week, right? So you just have to be thinking about that. And then what could that look like in 10 years? Because we only look at like 1 year, 2 years. I would implore you to look at 10 years, right? What would that look like? And that gap, right, between that 4.5% and like 8 to 10%, that compounds to about 6 figures. And so that is money that you did not earn, and that's like freedom that you didn't build, but it came. And it's not because you made a bad decision, it's just because you didn't make a decision. You just let the money sit there, right? You left the money in the savings account past the point where the savings, like past where it was really serving its purpose and it was serving you. But again, we're taught to play it safe, and safe and still are not the same thing, right? So we just left it there and we left it still. So again, right, I'm not telling you to be reckless, but I think the idea that we need to start thinking about, we need to start learning, is how to be intentional, right? You have to start knowing what every single dollar is for, and make sure that they're working exactly how they're supposed to be working. I think that's what we have to start thinking about, is being more intentional with every single penny that we have. And so I want to stay on point for a second, because it's on this point, it's very important, because it changes. It's the one thing that I've seen that changes people's minds, right? So we talked about the opportunity cost of not investing. Now I want to show you something even more uncomfortable, right? Your safe money, right, isn't just missing out on growth, like it's actually losing value. And I think that's also what you need to see. So let's go back to that $200,000 that was in a high yield savings account that's earning 4.5%, right? On paper, that's about $9,000 a year. It feels good, it feels safe, but like now let's add inflation. And inflation has been averaging anywhere from like 3 to 3.5% over like the last several years, right? And some years were actually a lot higher than that, which means that when you think about your real returns, like after inflation, it's only really about like 1 to 1.5%. And that looks like more like 2,000 to 3,000 in actual like purchasing power that you've gained. So even if you thought it was 9%, right? Like when you do the math and you include inflation and even to some degree capital gains tax, right, you're like not making any. The rest is just keeping pace with how prices are going up, because everything is going up, right? So now if you stretch that over 10 years, right, your account balance might show up at like 250,000. But in terms of what that money can actually buy, so like let's do real stuff like groceries, tuition, housing, travel, right? Your $200,000 really has a buying power of, it looks more like 165,000 in today's dollars, right? So you didn't just lose money on a statement, right? That's not what happened, but you lost it kind of like, again, practical. You lost it at the gas pump with what gas prices are doing. You lost it at the grocery store. You lost it in tuition. And it's invisible, right? But that's what makes it dangerous. Like we don't see it, but it's happening. So I'm not saying, again, I'm not saying savings accounts are bad, right? Again, that bucket one money belongs there. You have to have a safety net. But money that sits in your savings past the point of its purpose, it's not being protected. It almost feels like it's what's the word, it almost feels like it's eroding, right? And it's slowly, it's quietly, but it's happening every single year. And so savings, like it will preserve that number, right? But investing, which I think is more important, is it's preserving the value. And you really need to know the difference and reassess kind of what you're doing, how you're doing what you're doing. So again, right, I'm harping on kind of both of them because I think both of them are equally as important, but at the right time, at the right stage, and for what you need. So, and I want to be clear about like when savings is the right move, because again, I'm not anti-savings, but I'm just anti like still, or anti-stagnation. That's the right word. Because keeping money in your savings account when your safety net is not fully funded, that's your priority, right? So don't look at an investment opportunity, and none is worth sacrificing your financial floor, especially like when you think about your family, you think about where you're going, what you're building, you need that. So I would say, when I think about like keeping money in your savings account when you have like a major known expense, right? Maybe it's something that's coming in the next 6 to 12 months. Like if you're buying a house, if you're expecting like a big medical procedure of sorts, right? If you're maybe you're funding like a career transition, or you're even building a business, right? You're moving from maybe a W-2 to owning your own practice. Like you need liquid capital and you need it to be accessible, right? Then don't deploy it, keep it, hold on to it. I would also say like keep money in your savings account when, then this one's important. Like if you have a high interest debt of sorts, right? Let's say like your credit card, right? You have amassed some credit card, so just amass some credit card debt, right? And it's like 18 to 24%, then clear that first, right? Like just get rid of that. That's very important. I would also say like keep money in your savings account when your income is unstable or you're in transition, right? If you think like you might get fired, jobs are getting cut, or if you're even thinking about moving to a new job, again, I talked about starting a business, or like if you just think earning is not predictable right now, I would say stack some cash until things stabilize, because you might need it, because life will be lifing sometimes. And then I'd say keep money in savings when you are thinking about an investment, but you don't fully understand it right yet. So if you're considering something, but you're like, I just want to learn more. So before you deploy it, right, I would say keep the capital, educate yourself first, and then go from there. So in all these instances, saving is not the wrong answer. It's actually the right answer, but it's the, like, I would say it's the wrong permanent answer. So it's the wrong answer right now, but you have to think about it long term. So use it as like a holding pattern, but it's not your destination. So you're not saving forever. You're saving until you do this thing, until you do that thing, until you transition, until you build a practice, until whatever that is, right? And then until you learn the investment really well and you want to deploy it. But once that reason that you're saving for resolves, then the capital should do something else for you. That's how I would think about it. And it's very important. Now, so I kind of harped on saving, when to save, how much to save, what it looks like if it's eroding due to inflation. Now I want to talk about when to invest, and when should your money move from like sitting still, being stagnant, to working, because I think that's really important. I would say kind of the 6 conditions, and I think on a rare occasion, maybe not all 6 need to be met, but I think most of them really should be met. And I might even just say all 6 of them need to be met before you deploy capital. The first one, again, right? Make sure that your safety net is fully funded. It's sitting in a separate account that is like completely separated from your investment capital. If you put it all together, it's easy for the lines to blur, because you're like, well, do I really need this saving capital? Like, can I just deploy all of it? Don't do that. And then secondly, I mentioned this before, right? When you have no high interest debt that's working against you, like the math doesn't make sense if you're earning 10%, but you're paying like a 20% interest on your credit card. Just get rid of that first, right? Because it doesn't make sense to invest when you're still paying this large amount of debt. So just get rid of that. And then I would say another thing is like, you really want stable income. I'd say 12 to maybe 18 months. Passive investments, they require like a long hold period. So that looks like where your capital is tied up for like maybe 3 to 5 years. And so you're not going to get that capital back anytime soon. So you have to be confident that like your income is going to be stable. I might just say 12 to 24 months, just to play it safe, right? So that you're not in trouble if something happens, like say a transition. And then the fourth one, I'd say investing this amount is, if it's not going to change like your lifestyle or create stress. If investing and like writing that check, deploying that money, if it means that you're going to feel it, if it means that things are going to be tighter, If it means that it creates anxiety, that you can't sleep at night, or the first thing you think about when you wake up in the morning, and you're deploying too much, right? I would say right size the amount. And that might look like splitting it in half, because I think the right investment is one that you make, and then you go live your life. You go do your own thing because you're like, okay, the money's growing, it's doing its thing. It doesn't change anything that I do this second, that I do today. I think that's also important. And the fifth one, I'd say you really need to understand the asset. You need to understand the risk. You need to understand the timeline. And you should be able to like explain it to your advisor, your partner. You need to understand like what the investment is, how it makes money, what could go wrong, right? You should understand this thing. And also, when are you going to see returns? That's also important. If you can't go back to educate someone else about what you're doing, I don't know, you should just pause and go review it before you put your hard-earned money into it. And then I would say the sixth one, I think, is make sure that you've spoken to your tax strategist about how this investment is going to fit into your entire tax picture, because I think that's very important, because at the end of the day, the goal is to preserve your capital. So you want to keep more of what you earn. And I think a strategist who is proactive about helping you keep more of what you earn is the most important, because how an investment is taxed is just as important as what the return is, and how that will affect kind of your wealth building strategy. So I would say really all six are important, not most of them. For some people, maybe five, but like for almost all of us, it's going to be make sure these six make sense. And when they're all true, right? And then so you don't have to think, okay, now if I've done all of these things, I'm ready to invest. And the thing is, you're going to invest with a lot of confidence, which is going to help you make better decisions. And then you'll stay calmer during like the hold periods. Let's say you invest in a deal and they were supposed to give you distributions at month 3 or month 6, and it doesn't happen till like month 15, right? You feel stable because you're not relying on it, because you've built all the other ones. And so that's how you have to think about building real wealth over time. That's the big difference. So I want to give you real quickly like a decision filter that you can use every time, whether or not you should, when you're looking at your money and what to do with it. Like, should it move or should it stay, right? This is the 5 questions. Run your money through them every time. Again, this is kind of back to reiterating what we've said already, right? Is my safety net fully funded? If no, go do that, right? Just stop there and go do that. Because again, when we think about money and management, right, we have to make sure, again, that that's taking care of safety first. And then the next question is this money something that I won't need in the next, let's just say 3 to 5 years, right? If no, then it stays in your savings, right? Because again, a lot of passive investments are illiquid, right? They have hold periods. If you put money into a business, if you start something, right, the capital has to sit and work without needing it back. So that's how I would think about that. Again, and I go back to question 3 that I would think about is, can I explain this to someone, an advisor, a partner? And if you can't articulate what you're investing in, how it generates returns, the risk, right, then you need a little bit more education. And I don't think that's a weakness at all. I just think that's wisdom. So go do it, right? And then the 4th question I would ask is, will this investment produce income, growth, or tax benefits that my savings account or my savings can't, right? So think about that. And then if the answer is no, then why are you putting the money there, right? Because I have learned, right, not every opportunity is worth your capital. The investment needs to earn its place in like your wealth building strategy, your growth plan. I think that's really important. And then the 5th question is, does this money, deploying it, does it change how I sleep at night? If you're gonna sleep poorly, if you're not gonna be rested, right? This one is personal, and I think it's very important. And so even if it's a little funny, right? If this investment creates any sort of anxiety, if you're checking your phone, if you're calling the operator every week about how the investment is going, or if you're checking in, then you should really pause, and maybe you pull back on the amount that you invest, right? Whatever that is, maybe you half it and start there, or maybe you do another, maybe you half the half, right? That's also, but at least you start somewhere and you build. Remember, this is a marathon, it's not a sprint. So you don't have to do everything day one. I think that's the most important. So take a screenshot, save this, just think about it before you start. When you're starting to consider deploying capital, you should start thinking about this. I think it's very important. And then, so this is going to be quick, right? You don't have to, it might not be quick if you don't have all the information. And maybe I should have put this in an email, but I just want you to think about it, right? It's going to take, if you have all this stuff, it's going to take about 60 seconds. But I think at least just think about this, right? Think about maybe and you can do this later, right? When you have access to all your accounts. But if you could, right, pull up like all your bank accounts, your brokerage, your savings, everything. And if you can't, just estimate what you think you have, right? But and I think that'll be good enough for just thinking about this right now. But if you can, right, write down kind of every pool of money that you have, and I would assign it into kind of 4 labels. And some of us might have money spread across a lot of places. So at the time that you're re-listening to this recording, and you can pause and you can take your time to do it. But I would have all of it, and then think about these 4 labels. The first one I think about is like your safety net. So this is, again, money that's protecting you. It has to be liquid. Maybe it's earning something, but it never gets invested long term. Again, 6 months, right? So you have that, right? So looking at all your buckets of money, where you have money. Then I would think about the next one as like that, what we talked about, right? That growth engine. So this is going to be compounding over decades, right? If you touch this, you get penalized. So like your 401k, IRA, back to a Roth, like all of that stuff. Okay, so label that. Then I would look at like kind of that income builder, what we talked about, cash flowing assets, things that pay you, rental income, business distributions, dividends. If you have if you have a personal asset, right? Any of these, I would also label that. And then this 4th category is kind of like if unassigned. So this is like money that is just sitting, that doesn't have a job. It could be in your savings account, it could be in your checking account, it could be in your brokerage, and it just doesn't fit, right? I want you to ask, like, how much of that is unassigned, or how much of the money you have, and think about that number, right? Write it down somewhere, because that's the money that you should start thinking about really doing something with. It's money that could be working for you. So even thinking about like, putting it into like a startup, right? Or being an angel investor, right? Whatever that looks like. Again, you have to vet it well, but this is money that that could be working for you right now, and it's not working for you because kind of nobody ever told you to think about all your money and give it some sort of description. So I think that's important, right? Whatever that unassigned number is, think about how to start deploying it. So again, right, if you have all of it, is accessible. But if not, at some point, when you start thinking about wealth, building, strategy, growth, right? Think about these buckets and then be very proactive about figuring out what you want to do. And it'll look different for different people. So that's something to really think about. Okay, so real quickly, as we start to wrap up, right, I want to walk you through 5 mistakes that I think a lot of high earners make. And I want you to check kind of yourself as I go through them. So mistake 1, right, you're hoarding cash kind of out of fear. And this sounds like, I'll invest later, or I'm waiting for the right time, or like I want the market to stabilize, right? I think that's something that I hear a lot of people talk about, but the right time almost never feels right, because again, it's your hard-earned money. And while you wait, right, inflation is quietly eating, it's chipping at your purchasing power. So I think that's one of the things that you have to think about. Waiting has a cost. And a lot of us don't think about that, the cost, right? So it's not a cost that you see on your statement, but it's definitely costly. And then mistake 2 is, again, we've talked about this, investing your safety net. So please don't do that, right? Someone sees a great deal, they get excited and they like move money because they're like, oh, I'll just make it up later. You don't want to do that, because then 6 months later, it's not working and that capital is locked in and you need something, right? So don't do that. Protect your safety net at all costs. I've also seen kind of people, aggressively save, but they don't deploy. So they're like, I'm gonna do it. And they're saving, saving, saving. I see this with a lot of physicians and high earners. We just have a lot of money sitting. And the reason why is because you're very disciplined, but then the money's just accumulating and you're doing the hard part because you're earning it. Now deploy it. Go figure out how to use that to buy your freedom. And then I would say kind of the fourth mistake, as you think about it, is looking at what someone else is doing. This one is so important because like $150,000 to someone is going to be different from $150,000 for you, right? They might put it in a syndication and you might not be able to do that, right? You might need to put that in something different. So what you all of that, your debt picture, your family, your timeline, they're all different. So don't feel like you're looking at someone else and maybe you have FOMO and you want to do what they're doing. It doesn't fit. And I would also say another mistake is like tax implications. So two same investments that can show up like with the same gross return, they can look very differently after taxes. So I would always say just be aware of like what your tax burden is, and then be aware of the tax implication for every single investment that you're doing. That's why you need a team. That's why you need partners. That's why you need a tax strategist, because all of these things they can help you with. So I think those are some of the mistakes that I see kind of a lot of people making. And so again, as we wrap up, before you move money from savings into investment, right? I would say these are also, again, the people that you need to talk to. I've brought it up before, your tax, have a conversation with a strategist. So not just someone who files your taxes once a year, but someone who is thinking about how you can keep more of what you earned. And that is truly the key. You want to ask them like, okay, this investment I'm thinking about, how's it going to be taxed? How does it fit into like my overall tax picture? That conversation is so important because you can avoid mistakes. And then I would say have a conversation with your partner, right? So your spouse. I think this is essential because you need to be aligned on how you're deploying capital, on your like shared financial goals, your timeline, your risk tolerance, right? I think it's just important to have that, because I've seen couples where like one invests without the other fully understanding and agreeing, and it just creates tension, and we don't want that. So I think that's also important. And then the third conversation I would say is like with an advisor, and the advisor is more of a gut check. But for you to use this advisor, I think they have to be a fee-only fiduciary financial advisor, right? So someone who's not going to earn commission um, from that investment, like on the products that they sell to you, right? So then they can look at your full financial picture and really figure out. So I think that's a really important conversation to have. And then I think the fourth one is kind of just more like the education conversation, and that you're having with yourself. Like, can I explain this? Do I understand this? What is my risk? What's the timeline? Am I investing with confidence? Am I just having like FOMO, fear of missing out because someone else is doing it? Or I heard someone talk about it at work and I'm like, well, what are they talking about? I want to be part of that, right? So that is another conversation that I think you should have. So those are the four conversations. And I want to tell you real quickly about the shift, how this happened for me, because sometimes I think it's important to, one thing for me to talk about it, but two, for you to get a glimpse into what I used to do, what I do right now. And so I'll say this, right? I was not reckless with money. I was an oversaver, right? That was me. But my emergency fund was covered, my retirements were maxed out, and my savings account was really growing. And by any like traditional financial metric, like I was fine, right? But I felt stuck. And you guys, a lot of you know my story, but nothing was really producing income while I slept. And all of my money was either locked away until I was 65, right? Or sitting in a savings account, not really doing anything, and like just being eaten by inflation. And I had discipline, but I didn't really have a deployment strategy. And so that changed years ago, right? But the shift happened, I think, when I started realizing that like I had to do the hard part. So earning a great income is wonderful, but skipping the part that actually builds freedom is where I was missing, and not being able to put that money to work. And so I started thinking about, I did my research, I learned, and I picked, as you guys know, I picked real estate, I picked multifamily syndications. Again, I'm very well diversified now, but I really went deep on that asset class, and I can explain it to anyone. I love it. I understand the power of real estate long term. And so I made my first investment with confidence, right? And that decision is not the thing that grew my wealth, right? But it changed how I thought about money. And I think that's the most important thing, right? I stopped seeing savings as just like the end goal, and I started seeing it as like the launch pad, right? So I went from kind of just accumulating all this money to like starting to deploy it into really different cool buckets and cool vehicles. And eventually I went from investing in deals and I built the firm that now creates them. And so that's the origin of Phoenix Capital. And that's how I started. And every bit of it started with like that first decision to move money, right? I just had to. If you're thinking about growth, take care of savings and then deploy. Start thinking about true wealth building, like strategy, like cash flowing assets that you want to start putting your money and start small. None of this was built in a day, but you start and you build the discipline. And so if you're sitting here like where I was, right, that's okay. I think the discipline is already in place. Now you just really have to start thinking about deployment. So I'll show you what I did because I want to kind of be honest, and then I'll open up to question and answers. And I want to show you it's personal, but before I started like figuring out what wealth is and how to build and how to deploy, right? When I started my career, right, this is how my money was broken down. I was saving about 60% and I was investing maybe 10, right? I was like doing the bare minimum. And this was like when I first started building my career, and I was living off maybe like 30%, right? And on paper, I was very responsible. I was a great saver and my accounts were growing, but I was doing kind of what everyone told me to do. I didn't know better. And here's what was actually happening, right? The majority truly of my money was doing nothing. It didn't have a job. It was just sitting in a savings account and in a checking account, earning next to nothing, like almost zero, especially even after inflation. And I was honestly, I was just hoarding. I wasn't building. And I didn't even realize it because like the balance just kind of kept going up. And so it felt like progress. But today my allocation has completely changed and I save about 20%, and that covers like safety net, liquidity, margin for like a life surprises, but like, and then I live off of 20 and I invest the rest. And I want that to sit for a moment, right? I went from investing just 10% to flipping that and investing about 60%. This, please hear me, it did not happen overnight, but it did happen because like I did the exact work that I'm asking you to do today, right? I figured out like what is my freedom number? What were my expenses? What did I need to build 6 months of, right? I fully funded that. And then I stopped adding past it, right? I started spending time. I think I spent the most time getting educated. And then I got honest about like how much my savings was really just fear dressed up as discipline. I did that, but I spent a lot of time getting educated on different sort of like asset classes, different investment opportunities. And then when I felt comfortable, I started deploying into assets that I felt would, produce income, that would build equity. And then I also needed tax advantages. So that was also like a very key part of what I was thinking about. Now, also just hear me, right? My numbers are not your numbers. And I'm not telling you today to go invest 60% of your income. I'm not saying that. Like your bucket is going to look very different from mine. And it's going to be different based on like your expenses, your debt, kind of your family situation, your goals, your risk tolerance. Like it's going to look very different. But what I am telling you is that like the direction of that shift matters, right? So you have to, yes, I said have to, you have to move from mostly saving to like strategically deploying in the path that is like that works for you. So like going from being financially disciplined to more thinking about like financial freedom, but it has to work for you. How you figure it out, how you break it down, right? That's yours to decide, but the direction, right? That's the lesson. So moving in that direction. And I'll say this, right? It's still evolving, right? And I still adjust, right? Sometimes I don't invest as much. And maybe I have to save a little bit more if like something big is about to happen, or if I need to be liquid for something, right? So I'll still adjust it. I still evaluate like where I am. So the buckets are not static at all. And as like I would say, and they shouldn't be static for you either. So like as your life changes, like as your expenses shift, recalibrate. So come back to this, but you have to do it with intention. So it's not like, oh, I'm just going to do it just to do it. Like, you have to make it make sense. And that's the whole point of like everything that I've talked about tonight, everything that we've talked about. So I'm going to leave you with this, right? I told you a sweet 45 minutes and I went past that, but I'll leave you with this, right? Most of you who are listening are like, you already have the discipline. You earn well, you're getting to that earning capacity, and you save, right? You're responsible. I think that's the hard part, and you've already done that. A lot of you on this call, you've already done that. But I think what's missing is the strategy. And so knowing the difference between like the money that should be protected and money that should be deployed, I think knowing kind of like when your savings is serving you and when it's really holding you back, and knowing kind of how to move with confidence instead of uncertainty. I think that's what maybe you are learning more of. And so discipline, like, it got you the money. Strategy is, I think, is what's going to get you the freedom. And in that strategy is also getting educated and having the right people on your team. So I think that's the key of what I'm hoping that you leave here today with. So that's all I got. Thank you for being here. I really do want you to think about just thinking through all the monies that you have, where it is, how you need to move stuff. If there's money that's unassigned, think about how to deploy it after you have learned, after you've gotten educated, after you've had the right conversation, and then go for it. But at the end of the day, we all have to keep building and we have to keep growing. So that's what I want to leave you with. So thank you so much. If you have any questions, please feel free to toss it in the chat. I'd love to answer any of them, but other than, thanks for sharing. I try to get on your webinars when I can. I learn every time I attend. Oh, that's wonderful. I'm so happy to hear that. You are a great educator. I really needed this webinar today. Unfortunately, I am the responsible saver. Zero strategy. So you said zero strategy individual you're talking about. My question, approximately, how much do I need to start investing with Phoenix? Oh, this is a great question. Okay, so our minimum requirement is 50,000. And that's what to start investing in a deal. We are actively looking for our next deal. So I will keep you updated. But again, right, I love this, right? Because you know where you are, but you know where you need to be, right? So you're gonna start doing, right? Whether it's real estate, and I would say this is actually really good. I say to you, right, get educated, jump on a call with us, ask questions, figure all these things out, so that when you are ready to invest, right, you have done your due diligence, you've understood your risk tolerance, you know what you have available to invest, right? So all of that, you have to be thinking about that. But yes, it's okay. You know where you are. Now you can build from this. So I'm excited to see what happens in the next 6 to 12 months to like 5 years. But again, I'll say this, right? This is not a sprint. This is truly a marathon, and it's going to take years to build. But if you start now, you'll see tremendous result when you look back in like 5, 7, 10 years. So thank you for being honest and vulnerable to sharing that. I really appreciate it. Great job. A lot of good info. Wonderful. I'm so glad that that it was beneficial and it was helpful. I'm always looking for kind of ideas and topics to share to be able to educate our community. So if you think about a topic that you want us to go deep in, send it to our team, send me an email, send me a message anywhere on social media, you'll find me, and then I'll definitely be able to bring it up and have good quality conversation around it. So thank you so much, everyone, and have a wonderful rest of your Saturday. Perfect. Wonderful. Love that. Yes. Okay, everyone. It was really nice having this conversation. And thank you so much for all the feedback. Definitely we'll see you next month in our Investor Monthly webinar. Bye, everyone.